Good afternoon and welcome to this webinar on financial management. My name is Malcolm Fleming, Chief Executive of the NZIOB. This week's financial management webinar represents a change of tact. While the NZIOB's previous COVID-19 themed webinars dealt with topics the construction industry needed immediate information on as COVID-19 struck, focus now is to provide guidance on how construction practitioners and companies can make the necessary adjustments to successfully operate and ideally thrive in the post-COVID-19 world. In that vein, this webinar will focus on the topic of financial management and is targeted at companies, whether they be building companies, subcontractor firms, or design practices. As it always is with NZIOB events, it is important to us that we provide material that can be used by all of our members, regardless of which part of the construction supply chain they operate in. Today's presenter is James MacQueen, who leads BDO's construction and real estate team, which in 2018 launched an annual construction survey report, which has provided the industry with valuable insights into metrics such as profitability, margins, and risk management. James leads this work for BDO, and he is an NZIOB member. Along with his work on the construction survey, James works with several companies that operate in our industry. With construction a key area of interest, James developed some key insights into some of the challenges that companies operating in our industry have historically faced and the financial consequences of companies continuing to default to low margin or low fee behaviours. Addressing this last aspect was something that the NZIOB was keen for James to cover, as companies look to restore their balance sheets post the COVID-19 lockdown period. A key focus of the NZIOB is for the construction industry and the companies that operate within it to be resilient, to be profitable, and to be productive. Today's webinar is designed to provide those who manage or own companies with some guidance on how to create a financial framework to exit COVID-19 strongly. Before I hand over to James, I would like to make you aware of some upcoming COVID-19 themed webinars that we have under development. Contracts. We are informed that lawyers are seeing a number of claims post COVID-19 lockdown that relate to both the lockdown and ongoing alert level transition. It is therefore timely to undertake a post-lockdown type review and look at the way forward. We're therefore looking to schedule another webinar with Minter Ellison, Rudd Watts Partners, Janine Stewart and Stephen Price. Indicative timing of that webinar is mid-June. Later in the month, we'll circle back to the wellbeing topic with Site Safe and Mates in construction. We are starting to hear that mental health issues are starting to arise on site. A review on this and the development of strategies to mitigate concerns that are arising will be timely. Enjoy today's webinar and please pose any questions that you have on the question function on the webinar platform. I will rejoin the webinar at around 5 to 1 to facilitate the Q&A session. Over to you, James.
Thanks, Malcolm, and hi everyone. Pre-COVID, we experienced the longest and strongest period of growth in the sector in all of our working lives. Most companies' balance sheets were the strongest they've ever been. So generally, we entered this economic phase in a very strong position. However, I will show that it can unwind incredibly quickly, and certainly the lockdown has stripped some of the strength from the strong balance sheets and weakened some of the fragile balance sheets. There are many components to financial management, and I intend to focus on specific actions that you should be considering and taking over the next few months. They are actually things that you should have been doing already and should continue to do even when things improve. I don't intend to cover the tax changes and tax incentives or the wage subsidies. There's already plenty of material available on these. There are a number of recurring themes which permeate the webinar. The first is that cash is king. It sounds cliche, but in times of crisis or in a downturn, it is lack of cash more than anything else that precipitates demise. We're entering a period when decisions are going to need to be made very quickly, and you need quality information to make those decisions. That comes from using all of your existing systems properly. That's one of my passions. More than that, efficiencies and profit can be improved if you use your systems properly. There's no point looking backwards. We need to be looking forwards and forecasting, forecasting and reforecasting. And then everyone who relies on or uses that financial information or forecasts needs to be skeptical. You need to challenge the information provided. Make sure that it's sending the correct message rather than the message you would like to see. And when things start heading in either the right direction or the wrong direction, it's a matter of acting quickly and decisively. Most of you will be familiar with the phases of the construction cycle, and most of us has seen one or more cycles. The positive thing about these cycles is that history repeats itself. Similar things happen at the same point, and we can learn from that and respond from that. We've climbed to the top of the curve, and we're in phase 3, which I refer to as the high risk period. A few companies have grown beyond their true capacity to manage all the projects and have the capacity of their balance sheet. And there'll be some stress. I think most are going into this a particularly strong position. If I had better PowerPoint skills, I'd draw a little step down at the top of the curve representing the lockdown. As we start dropping down the curve, there will be a drop in volume of work, and that encourages silly pricing. I really strongly counsel against that. Job losses from that high risk period will also start biting into cash flow and reducing profit. First reaction of management is to start cutting overheads. At the moment, most companies have plenty of work from existing projects at prices that were negotiated when everyone was busy, and there was no incentive to have silly prices. The profits from these jobs will help through the first phase, but as those jobs come to an end, we will start seeing more intense competition for the new projects. Inevitably, there will be some contractors and main contractors who don't survive. Generally, they will have had issues during the high risk period, and together with the massive cost caused by the lockdown and the new way of working with social distancing, directors may need to make a difficult decision. And that will probably be triggered when existing projects start ending. The collapse of both main contractors and subcontractors has a ripple effect through the rest of the sector and is at risk of causing a domino effect. Therefore, we all need to be particularly vigilant as to who our clients and suppliers are and closely manage the risks that go with this. There's generally more litigation as we slide down the curve, with some contractors and subcontractors no longer in business. There's additional pressure and risk on the companies remaining. As we move further down the curve, all these issues compound. Profitability reduces further, balance sheets become weaker, and cash dries up. This slide, which highlights the key findings from the BDO 2019 construction survey, as being the greatest challenges and concerns that you all had in 2019. I expect that if we ran the survey again today, the key issues will be around margins, cash flow, the economic outlook, and mental health. During the lockdown, most of you would have been carefully thinking about which projects will continue, which planned projects may still happen, and which ones will get canned. You will have been preparing initial forecasts, and by the end of the lockdown, probably had version 3 or 4 as more information was gained. My key point is that forecasting is a critical, continuous process. It's not an annual or a quarterly process. As we move forward, we should be reviewing and updating our forecasts at least monthly. Forecasts need to be integrated. By that, I mean contain forecast profit and loss, forecast monthly balance sheets, and the forecast cash flow, as these three things all interrelate. In construction, good forecasting starts with preparation of a schedule of the projects, with the months in which they will happen and the likely revenue and the costs occurring at each month. In one sense, forecasting in construction is easier than most other businesses because you know what projects you're doing and the project managers have a pretty good idea of what will happen each month. But in construction, that's where the easy part ends, because after that, doing forecasts is very challenging. In my view, your base projection should only have confirmed projects. Anything that is not confirmed is currently blue sky due to the risk of planned projects being abandoned or significantly delayed. Once you put in the confirmed projects into your base forecast, by all means put in the other projects that have a colour coding system depending upon the likelihood of them occurring, and have little subtotals after each colour comes in so you can see what the impact of that is. Personally, I would not be putting any blue sky in projections at the moment. We need to be relying on what we are confident is going to happen. We need to make our decisions around that. You should have a schedule of the risks and opportunities in your projects. And some software programs actually have a column for that. And so what I mean by that is the things that may happen, but are not the conservative base case. And keep updating that continuously because those things tend to change over time. Now, particularly for head contractors, bonds and retentions absorb a phenomenal amount of cash resource. And with the bank's attitudes to the sector, the requirement for cash backing for the bonds isn't inevitable. So list out the projects, the bonds required, timing that those bonds need to be established and finally released, so you know what cash is being tied up. Your cash flow statement plus the bond schedule and a similar retention schedule will then lead you to a schedule of accessible cash. It's this accessible cash that is the one to watch, because when that starts getting tight, it all starts getting difficult. Also incorporate schedules with your bank covenants and key ratios so that you can monitor these and be proactive in talking to the bank if covenants are likely to be achieved, rather than waiting for the bank to tell you that you're in breach of the covenants and that they are changing the rules. BDO encourage you to have a 13-week detailed cash flow. That way you can identify the tight spots in particular weeks, and by going out 13 weeks, gives you enough time to identify issues and respond accordingly. Forecasting is a team effort. It's not just for the accountant. It includes the quantity surveys and the whole management team at the minimum. Just because something is produced by computer and looks pretty does not mean it's correct. We all need to be particularly skeptical if the information is provided to us and ensure that it portrays the correct position. This is particularly true of projections, but also work in progress calculations and your management accounts. Do they make sense? Do they portray reality? Personal view, I think quantity surveying is a bit of a black art, and they usually like to keep a few reserves up their sleeves, and there's probably some scope to manipulate the numbers. You need to delve in and determine where things may be being under or overstated. Your CFO, whoever is preparing the projections, is not at the coalface of the projects and doesn't know everything, and therefore they need help and a watchful eye to ensure that the projections are as realistic as possible. Similarly, directors and senior management can't simply rely on what's put in front of them. They need to apply skepticism as well. This is a team effort, and dumb questions are usually the good questions. And just because somebody is more senior than you does not mean their view is more correct than yours. I employ everyone to use your systems, both operational and financial systems, fully and properly. So that includes project management systems, your project cost recording, your accounting systems. My biggest frustration last year was cleaning up messes from people who were not using their systems properly and generating incorrect and misleading information. In challenging times, we can't afford to have poor data and poor decisions. And similarly, we can't afford having surprises. There are positive aspects too. If systems are used properly, it leads to efficiencies and performance improvement and profit improvement, and helps meet your planned schedules for the projects. Reliable information has proved useful during disputes as well, or documenting what happened if you are having a dispute. It's pretty obvious that downturns or losses occur rapidly and therefore require a rapid response, and that needs quality reporting. This next slide comes from the BDO 2019 construction survey, and I highlight a few issues from this. Top left, we set out the typical requirements for a head contractor for cash, for security, for bonding, and for retentions. That often is up to 10% of turnover. With tight margin overheads, it takes many years to build up cash resources of 10% of turnover. And during a downturn, this can disappear very quickly. So I anticipate seeing some pressure on having enough cash for these things. On the top right, we looked at the ability to provide performance bonds. And this time last year, only half the industry actually had capacity for additional bonding if they had an additional project. This is going to look significantly different now. And I see that the Minister has just announced changes to the retentions regime that's going to put more focus on retentions. At bottom left, we looked at cash collections, with the green being 2018 and pink being 2019, and could see a trend emerging of cash collections becoming a real issue for cash flow. I imagine that if we did this survey again now, it would look significantly worse. And on the bottom right, we looked at retentions compliance and found that only 2/3 were holding the retention money in a separate bank account in trust. And some people still preferred not to answer the question, which meant they're not complying with the retentions regime. I'm concerned that as cash gets tighter, compliance with that regime could deteriorate, and therefore encourage those that hold retentions on trust, have retentions held on, their retentions held on trust, to ensure that those are being actually properly held in a trust account and properly safeguarded. Now it's time for some scary numbers. I've done some calculations of the impact of the lockdown on cash reserves, and I'm using percentage of profit as my measurement base. We locked down for 5 weeks for most sites, and time was lost securing sites prior to the lockdown and restarting sites. So I've done my calculations, assuming 6 weeks of lost work. I've also assumed no claims for any contribution from clients, and I appreciate that some have had contributions and some haven't. BDO do extensive benchmarking of head contractors, and if we use an example of a head contractor at the middle point of our benchmarking, so it's the average, and one that has very few tradesmen on their payroll because they subcontract most of their work, the lockdown has likely deprived them of up to 25% of a year's profit due to losing the gross profit for the period and continuing to have those overheads. If I drop down to the 75th percentile of benchmarking, in other words, 3/4 of the good ones above and 1/4 of the struggling ones below, those companies likely lost up to 50% of their profit during the lockdown. It gets more ugly for head contractors that have a lot of their own staff on the tools. And while each one is different, some of those possibly lost up to 75% of the year's profit during the lockdown because they couldn't get out there and generate gross profit to cover their payroll costs and cover their overheads. If we do look at subcontractors, and I use a painter because they have a very high wages compared to others because their materials are not a massive part of their income. If we assume their net profit was 10% of sales, they will have lost about 60% of a year's profit during the lockdown. And that also assumes that all the painters are on their payroll rather than independent contractors. If we take a more common subcontractor where wages are say 30% of cost of sales and net profit is say 5% of sales, they lost about 70% of a year's profit during the lockdown. My key message is the lockdown has seriously weakened people's balance sheets, which is going to leave many companies vulnerable and needing to be looked after. Now that was the past, but what about the future? Because some companies are expecting a decline in work once existing projects are completed. My sense is that we're fine for a while with existing projects, but it's once they come to an end that we'll start seeing some challenges. Now for a head contractor who's able to keep his overheads at 4% of turnover, if they suffer a revenue drop of 50% and immediately, and I stress immediately, get rid of all staff that are not required, at best they would break even. That is only if they respond really quickly and only if they can maintain historical margins on new projects. I think that's probably quite an ask. If we have a head contractor or a subcontractor operating a margin of 10% and overheads of 8% of turnover, in other words, profits only about 2% of turnover, they can only afford a revenue drop of 20% before they hit a break-even point, unless they radically restructure their business. It's even worse for consultants like architects, engineers, quantity surveyors, project managers. If they are operating at a level where net profit is 10% of turnover, if their revenue drops by 10%, they will only break even unless staff are immediately released. And we've seen some of those firms start releasing staff very, very quickly because they saw a bit of a downturn coming. Now, these examples clearly demonstrate why we need to be constantly measuring the situation, doing our projections, and making sure they're right and responding rapidly when things change. The decline curve is a measure our insolvency team use, which demonstrates if we don't start making changes quickly as the situation deteriorates, we rapidly run out of easy options and move towards the red zone, which is sort of receivership or liquidation. The key thing is we need to be assessing it, and there's two types of restructuring. There's operational and financial. We usually start with the operational restructuring, and that is identifying the cause of the problem and then developing and very, very quickly implementing a strategy to improve things before we slide further down that decline curve. I expect most restructuring in construction building sector is going to start as operational restructuring. And I think most of you are probably thinking about that already. Financial restructuring in the sector is more challenging, particularly given that the banks have very little appetite for the sector. So we can't expect the banks to bail out a sector in which they've already suffered significant losses. Given I had emphasised how important cash is, let's look at some of the areas we can preserve and generate cash. The one that has the biggest impact is focusing on quality revenue and picking up new projects, but I emphasise only at good margins. Sales for sales' sake at poor margin just speeds up the race to the bottom. The other area where improvement can be made is improving your margins, which is efficiencies on the projects. Really good project management, really good risk management, and being innovative in the way that you run your projects and managing your staff. Now, depending upon your sector, around 85% of your costs are in cost of sales. So that's where the big number is. So if you need to make big changes, you've got to start where the big numbers are, and that is the area where potentially you can make the biggest improvements. Unless, as I said, you can generate additional revenue, because that's the easiest. My comment about removing fixed costs from cost of sales is particularly focused on the consultants and the non-site professionals, because there the payroll cost is treated as a cost of sale, but it's actually a fixed cost in the sense that it continues whether the staff are generating revenue or not, and therefore needs to be actively managed. The same comment applies in subcontractors and head contractors, but to a lesser extent. Reducing overheads is pretty obvious, but most companies are already pretty tight on their management of overheads, so that can be quite challenging to make big changes quickly. Good management of work in progress has a dramatic impact on cash flow. That's one of the first places to look. So any work in progress that is a debit balance or a positive balance or appears on the asset side of your balance sheet, it to me is a concern, and it needs to be billed and turned into cash as quickly as you can. Most contractors are adept at managing their progress billings to keep work in progress either tiny or at a credit or negative level. Whilst clients may not appreciate that, I encourage it as a way of managing your balance sheet and preserving cash. For all businesses, it's a matter of invoicing promptly and collecting those receivables promptly. Your credit controllers need to be particularly assertive in managing it. Another easy one is minimizing fixed asset additions. So think no new cars, no new computers, no office fit outs, because that all sucks cash. And also, if you've got genuine surplus assets that you can generate some cash by selling them, then by all means do that and generate that extra cash. Restructuring debt is pretty obvious, but the details of that are going to be quite specific to each organisation and their cash flows and their securities. There are a few financial products available for small sectors in the building sector. There is a new retentions insurance product about to be released, and that will help free up some cash that is otherwise tied up sitting in retentions trust accounts. And for a few subcontractors and material suppliers, it's possible to get factoring of their debtors, but again, given the risk of bankers to the sector and the general risks, I think there's going to be constraints around that. So what else should we be thinking about? You should be talking to your bank, but never go to the bank telling them you have a problem. You need to go to the bank with a carefully considered solution and projections showing them that you can repay any bank facilities, and then you can have a worthwhile discussion with them. As we've seen, things can deteriorate quickly, so it's a matter of going early and going strong. It's a bit like pruning a tree. There's no point playing around with the twigs. You have to go in and remove all the weak branches, or you will forever be pruning and not making significant progress. Communication is key. Communicate with your employees what is happening and what you're going to do, and you'll have their support. They will want to preserve their jobs and will normally go way beyond normal expectations to help the company to survive and preserve their jobs. It's much the same with upstream and downstream with your clients and suppliers. Keep communicating with them and enlisting their support. Unless you can clearly afford it, now's not the time to buy new boats, expensive holidays, and some of those other things we've been spending our money on recently. Drawings need to be strictly controlled for smaller businesses, and unless the company is in a strong position, dividends need to be delayed to preserve the funds in the business. There's no point doing work if you're not going to get paid for it. So be very selective as to who your clients are and who you work for, and the risk management around that becomes even more important. Similarly, don't take on projects that you don't have expertise to do or the balance sheet to support. Some of the previous construction company collapses have occurred where companies moved beyond what their team was skillful at and started projects that were outside their immediate skill set with disastrous results. So learn from that and don't repeat that. As we saw in the construction cycle at the beginning of this webinar, there's likely to be financial collapses, and therefore selection of subcontractors and suppliers becomes critical. One of the very first lessons we learned before the lockdown was reliance on overseas companies as a key risk. So hopefully that drives everyone to supporting New Zealand-based companies wherever possible. Focus on the future and not the past. That's pretty obvious, and that's where projections and focusing on generating new work is critical. We will come out of this, so also continue to plan for the recovery. There will be some fantastic opportunities for those that have the strength and can plan a bit further ahead. And don't try to row this boat on your own. Seek advice, talk to people, and obtain help. If we get back to numbers for a minute, as I said before, BDO do extensive benchmarking of head contractors. So a number of successful head contractors operate on overheads of under 3% of turnover. Many have overheads at 8%, and that is at old turnover levels rather than new turnover levels. So as revenue drops and the risk of margins tightening increases, getting your overheads down to 3% is going to make a big difference. So I said for all the construction companies out there, that's your new target. That's what you've got to try and head for. Consultants and professionals have a real challenge. As I said before, we show our staff costs as a cost of sale to determine our gross margin, but they're a fixed cost and not a variable cost because staff need to be paid whether they're generating revenue or not. So if revenue drops, unfortunately, it means that staff need to be managed as a variable cost, and that inevitably and unfortunately is going to mean that some redundancies to help an organisation survive. Calculate and continue to recalculate your break-even point. And you need to do this in conjunction with your cash flow, because even if you're operating profitably, but cash flow negative, just being profitable may not be good enough. For head contractors and subcontractors, you have a lot of staff on projects and recorded as a cost of sale. But as they come off projects, their cost becomes an overhead and increases your break-even point. So obviously plan A is to find new work for them, but if that work is simply not available, then other actions may be required. Directors have quite significant obligations in relation to trading, in relation to not trading recklessly and not allowing a company to incur liabilities if it is unable to pay them. A new safe harbour regime has been set up. It applies through to September this year and protects directors, provided that the company was able to pay its debts in December last year, and liquidity problems are due to COVID rather than other reasons, and the company is likely to be able to pay its debts properly and when due by September 2021. That gives a breathing space, but only if those conditions can reasonably be met. To break this up a bit, a little story about three well-known NZIOB members who some of you will recognise from the photo. We participated in the international game tournament in Samoa, and on the first day, all of the boats, except one, went out to the front of the island, fished all day, and most got nothing, and certainly no marlin. The NZIOB team wanted a different result, so we did it differently. We went round to the other side of the island and caught the only marlin that day. It ended up being the only New Zealand boat that caught a marlin for the whole competition. My key message, if you keep doing the same thing, you'll get the same result. So if you need or want to do a different result, then you need to do it differently. So be brave and be decisive. Whilst the best strategy is to secure more work, let's not be what I call busy fools. Revenue for revenue's sake lays a fast track to demise. Revenue needs to be on good projects, at good margins, with managed risk and an assurance that you're going to get paid. Failure to follow these key principles just puts you at a head start of the race to the bottom. And that's the last thing the industry needs. Therefore, my key themes are that you need quality information that can lead to prompt decision-making, quickly followed by appropriate, prompt actions, but always remembering that cash is king. We'll finish this a bit earlier than planned, but we'll go back to Malcolm for questions and answers.
Thanks very much, James. I particularly enjoyed the New Zealand NZIOB fishing story. I hope you named the entry NZIOB. That sounds great. Yeah, I'm very pleased that you're reinforcing the issue around good margins, and you made a comment here, low margins accentuating the issues. We don't want to have busy fools out there. And after the GFC, we certainly saw a lot of people dropping margins, with contractor or subcontractor, or whether it be design firms dropping margins and getting into unproductive work. And as you've indicated, that just accentuates the whole issue altogether. Something you picked up on earlier was reinforcing using good systems. I just wondering if there's perhaps an opportunity to give a bit of an overview of what good systems should be comprised of.
Yeah, it's good to have the best system, but it's almost, I'd rather people, even if the system is not perfect, to use it properly, use all its features. And it's one of my passions. Not all, but most of the new clients we've picked up recently, we've spent too much time just doing housekeeping, cleaning up messes and so on. So, and without wanting to sort of nominate particular brands, big companies or big head contractors might use CHIOPS or CostCon. They're a bit expensive. CAT from construction software is used by lots of companies up to about 150 mil turnover. There's lots of features in these systems, so you need to train your staff up to use them properly. And if all the staff are using them properly, you get really, really good information. And it makes the job of the QS easier, it makes the job of the accountant easier, management's getting reliable information. It's one of my passions, and I really, really encourage people to do it properly.
You also mentioned as a tool to consider to free up cash, particularly for retentions, a bonding product that was coming to market. Are you seeing an uptake on contractors, main contractors looking to use bonding products?
Yeah, there's the first product was a Ula Hermes one, which was too complicated, and I think only one person took it. Then a number of people took an insurance product from an insurance company that no longer exists. But there's QBA through the brokers are in the process or about to launch a new product. I was helping work on it just prior to COVID, so I'm not quite sure where they're at now, but certainly talk to your insurance broker, because the intention of that is that if you've got that as a complying instrument, then that will free up cash that's otherwise sitting on your balance sheet. But I would emphasise that the only people that are likely to get it are those that have a strong balance sheet. So it's not for those looking for an easy answer that already have a weak balance sheet.
Okay. You mentioned also on there that the CFOs or the MD or whatever the case may be, sort of as a forecasting, having regular updates with their QSs, with their project teams, being project specific about what the cash flow requirements are for specific projects. In your experience, and you deal with a lot of companies, and admittedly a lot of them at the top end, are you seeing good practice in that area?
It's a little bit mixed. The bigger ones that have got quite, really good CFOs are generally doing a good job. And they've got quite sophisticated models. And it actually takes a long time to build a really, really good model. I think the challenge is more with the smaller companies that can't afford people with that skill set. And yes, you could get somebody else to help you do it. It's expensive, but you need to do it, because otherwise you don't really know where you're going, and it all turns to custard very, very quickly.
So just starting to get a few questions popping in here, but I just want to tease out a couple other things that you mentioned, perhaps more on the benchmarking side of things. Before we started the webinar, we had a bit of discussion about balance sheets, and during your presentation you made the comment that balance sheets are historically quite strong, particularly with main contractors, which is great news.
Yep.
As opposed to, say, the GFC, which was the other, the 10 years ago, we had this another huge disruption. So compared to the GFC, what sort of shift have we seen in balance sheets? Have they, they've risen, what sort of level since those days?
Yeah, if we go back, say, 3 years or so, then I think generally balance sheets were still weak and margins were still too low. I won't take credit for this, but in the construction surveys, we've been talking about increasing margins, and for whatever reason, people have been improving their margins. And I think that's starting to improve balance sheets. But certainly the balance sheets for 2020 that I've seen so far have been quite a lot stronger than the balance sheets at 19 and 18. And I really attribute that to a period that's been long enough and strong enough to actually build those financial resources without too many major catastrophes, and also a focus on probably just better quality management as well.
And margins, this is mentioned a number of times in your presentation. One of your final slides talked about a good contractor generally has, as a percentage of turnover, overheads are at 3%. Now, you ought to pick this up in your survey, because you run the survey 2018 and 2019. What sort of percentage of main contractors are getting down to that sort of low level of 3% of overheads represented as turnover?
I've got a number of clients, both big, as in sort of close to 200 million turnover, and middle, say 50 million turnover, that have got their overheads down to in about, in 4 cases, under 3% of turnover. So it is possible. It's, you know, they don't have big flashy offices. Everybody's involved, or most people are involved in projects, so not too many people in the office. It does suit companies that have a smaller number of large projects. It's a whole lot harder for companies that have lots of small projects. So therefore, if you're doing lots of small projects, you actually need better margins, because it'll be very hard to get down to that level of say 3% of turnover.
In terms of net profit, before coming on, we talked about over the survey 2008 and 2019, you've seen a rise in profitability of firms. Did you want to talk about that?
Yeah, well, I won't go into too much detail because it's all a bit sensitive for those people involved, but certainly 2020 has been more profitable than 2019, and 19 was more profitable than 2018.
So it's going in the right direction.
And it's driven from margins. If you don't get the margins up and keep the margins up, you won't get the profit at the bottom line.
That's good. And in your experience, as you know, NZIOB members, well, we're both NZIOB members. Members are spread across the supply chain, including many in architectural, engineering, QS, PM firms. In regard to how they're operating historically with their margins and profitability, is that they also been increasing over the last few years?
I don't have enough, I suppose, breadth or spread of those to get a good response. But we've seen at various times they've been sort of reducing their level of staff, and I think that's a bit of a measure that it's challenging for some of those firms.
Very good. Okay, I've got a couple of questions here. What can client reps do to support construction companies during this period, and how many companies do you see not making it through? Well, let's focus on the first part of that question. So client reps, I presume they're talking about the likes of suppliers, whether they be merchant suppliers or product supply or services supply. So how can they assist?
Obviously, one of the ways is that if cash is a little bit tight, agreeing payment terms, and even if those payment terms is not 20th of the month, it's once the client has actually paid for a particular project, which just takes those little awkward lumpy bits out of cash flow when you've got to pay your bills before the cash comes in. Obviously, keeping pricing keen helps with margins. And if I come back to my comment, 85% of your costs are sort of costs of sale. If you can do a little bit of pruning there, then that helps create a bit more margin. I suppose if I throw it out wider than that, there's plenty of margins out there. We've got to share it around so everybody gets a little bit to keep everybody in business.
And something we didn't talk about, but is quite well known, been quite a bit of commentary on it. If we're forecasting that the size of the market in terms of work available is going to reduce, unless a company, whether it be a design practice, main contractor, subcontractor, supplier, whomever, doesn't make some changes to increase their market penetration, their own business will reduce at the same rate as the market does. So focusing on marketing and how to get into new markets, develop strategies on how to expand horizontally or vertically. Any sort of comments on that as a strategy for businesses?
Yeah, I think you've got to be very careful. I've had a few clients over the years that thought that they would diversify and have a number of subcontractors within their group, so those subcontractors could work on the group. Generally, that diversification hasn't worked. As I said before, some people are very good at a particular style of building and try and do something else and don't have the skills and don't get it right. So you've got to stick within the skill level of your existing team. And it's probably my key theme. And if that means you've actually got to downsize the organisation a little bit to sort of a key team doing a smaller number of projects on low overheads, then do that and then wait for the opportunities when things pick up again.
or conversely find more clients with those sort of projects that you do particularly well and profitably.
Yeah, which everybody else is going to be doing as well.
Yeah, so you have to be good at that. Well, here's a question. This person's a junior QS and also a student, so must be studying at the same time. Can you please make some suggestions on how to enhance the hygiene of the retention regime, please? They're suggesting a more transparent financial policy law, encourage people to put the retention in the trust. Well, we've had something from the Minister just last week, and you mentioned that, so perhaps, do you want to pick up on that?
Well, certainly, yeah, so there's not a lot of detail yet, but basically the Minister's come out with a statement that first of all is going to introduce a penalties regime. So that will help, well, is intended to encourage compliance with the regime as there's still significant non-compliance. It's intended to resolve the confusion around intermingling, which we all knew was never going to work anyway. And broadly, that sounds like it's going to mean that the retention money needs to be held into an account called a trust account or something similar. And the third one was greater transparency over the amount that's actually held in trust. Now, that transparency, it's actually been there if people have asked, but people have not been asking. So I see that as being the easy bit, because most computer systems these days will produce the reports you need to provide that.
One question I can answer: will this webinar be available to listen to again? Yes, if you're an NZIOB member, just go onto the NZIOB member dashboard and you can watch it. Rewatch it as many times as you like. That's concluded the questions that have been provided by the attendees, and since the same numbers stayed with us throughout, so that's good. Any final thoughts? I've sort of covered the burning questions that I had.
Probably a key one for me is around governance. And projections and skepticism is part of governance, but if we can get our governance really good, then that is going to help the whole industry.
Right. Well, thank you very much. And again, this webinar is available on members' dashboards, and also we'll be sending out, and also on the dashboards will be a full copy of the slides. So thank you once again, James. Really appreciate
Thank you very much
for this, being involved in this webinar, and for that ongoing work regarding the construction survey that you've taken the last couple of years. As you know, we're big fans of that piece of work here at the NZIOB. So thanks again.
Thank you very much.
Thank you.